I'm Doris. I'm going to be updating you about today's market today. The market generally closed lower today, and we can see there is a rise in my portfolio. Right now, the net asset of my account is 70,207.19. SQQ have rose for 3.29% to 20.1. United Natural Gas has closed down 2.37% to 7.00. The market generally closed lower. Dow Jones Industrial Average closed down 0.52%, Nasdaq Composite closed down 1.15%, and S&P 500 closed down 0.76%. Today, the auto manufacturers closed the lowest as Tesla led the loss, and other industries that closed lower were the banking sector and the semiconductors. And Wall Street knows how hawkish the Fed is and may continue to shrink its balance sheet when it cuts interest rates next year. Minutes from Fed's most recent policy meeting showed that Fed officials are seriously discussing the possibility they may not have to shrink their massive balance sheet when they start cutting interest rates. According to the minutes of July's 25th to 26th policy meeting released Wednesday, several participants noted that the balance sheet reduction process does not necessarily end when committee finally begins to lower target range for the federal funds rate. This approach, which some policymakers, including Fed Chairman Jerome Powell, has mentioned could possibly pose a challenge of Fed's external policy communications, but it certainly reveals a hawkish tone within the Fed. This is because balance sheet reduction, known as quantitative tightening or QT, is often interpreted as a key strategy for tightening monetary policy. Interest rate cuts do exactly the opposite, easing monetary policy by lowering borrowing costs. In their latest interest rate outlook released in June, Fed officials have predicted that policymakers will start cutting interest rates sometime next year. While rate cuts are usually designed to buffer or stimulate the economy, as in the early stage of the pandemic, Fed officials may cut interest rates next year just to ensure that the rates don't become too strict when inflation falls, primarily to avoid an economic downturn. To that end, some officials said the rate cut would not necessarily undermine the Fed's effort to continue tapering its portfolios. If we cut rates to pull back to a neutral position, there is no reason to stop shrinking the balance sheet. My expectation is that there is room for our balance sheet to continue to shrink for quite some time. Dallas Fed President Lori Logan said last week that she was previously responsible for managing the Fed's bond portfolio. Official data shows that as of last week, the size of the Fed's balance sheet was about $8.2 trillion, well below the peak of nearly $9 trillion last year. During the pandemic, this balance sheet swelled sharply as the Fed bought sky-high amounts of Treasury bonds and mortgage-backed securities to stabilize market and support the economy. But since June, the Fed has been divesting some of its maturing assets from its balance sheet, a process that is now proceeding at a rate about $1 trillion a year. Quantitative tightening can be an unstable path for the Fed. In the last Fed balance sheet reduction cycle, the Fed was forced to end its first unsuccessful attempt in 2019, as a sharp rise in borrowing costs caused by the reduction of the balance sheet was frightening the market. So far, while the rate of balance sheet reduction has been almost twice that of 2008 and 2019, the latest round of tightening has gone fairly well. Investors say the resilience reflects the fact that the global round of tightening global financial system have been flooded with cash since the pandemic, and that the brief floodgates during the year's banking crisis have also moderated the shrinking rate of balance sheets. However, further tightening in the future may become more challenging for the market. Jane Barry, co-head of the U.S. interest rate strategy at J.P. Morgan, said earlier this month, a second round of trillion-dollar balance sheet reduction could have a bigger impact. The first trillion comes against a backdrop of a rapid rise in the federal funds rate, and the second trillion is more important because it comes against the backdrop of accelerated supply of Treasury bonds. The Fed is aiming to cut another $1.5 trillion from its balance sheet by mid-2025. At a time when the U.S. government is dramatically increasing the size of its bond issuance and demand from foreign investors is waning. That could push up borrowing costs for government and the businesses and hurt many investors who bought bonds in a large number this year. Manmohan Singh, senior economist at the IMF, predicts that another $1 trillion in quantitative tightening could be equivalent to raising the federal funds rate by another 15 to 25 basis points. As the interest rates stabilize, the effects of more quantitative tightening may be easier to see. In fact, the continued rise in U.S. Treasury yields has become quite unusual recently, with market expectations for another federal rate hike consistently well below 0.5%. The yield on the 10-year Treasury, the key benchmark of interest rate for the overall economy, closed at 4.258% on Wednesday, up from 4.22% on Tuesday and its highest close since June 2008, according to Tradewell. For Wall Street investors who bet that the risk for Fed's monetary policy tightening has been lifted, the pressure of the U.S. stock and bond price market this month may have poured cold water on them. That's all I have for today. Thank you for listening. Please subscribe and see you next episode.